Hello everyone, and welcome to our channel. In this video, we'll be discussing the Great Recession, which is one of the worst financial crises in modern history. Specifically, we'll be looking at the root causes of the crisis and what factors led to its spread and severity. The Great Recession, which began in 2008, was triggered by a number of factors, including 1. The housing market bubble. The housing market bubble refers to a period of time when property prices in the United States rose rapidly due to an increased demand and easy access to credit. This led to a housing boom, with many people buying homes they couldn't afford with the expectation that prices would continue to rise indefinitely. However, this boom was unsustainable and eventually the bubble burst, leading to a collapse in the housing prices and a rise in mortgage defaults. 2. Subprime mortgage market. The subprime mortgage market refers to the practice of lending money to people with poor credit histories or low incomes, who are often unable to make their mortgage payments. These loans were packed together and sold to investors in the form of mortgage-backed securities, which were supposed to be a safe investment. However, as defaults on these loans increased, the value of the securities plummeted, leading to huge losses for investors. 3. Deregulation of the financial industry. The deregulation of the financial industry, which began in the 1980s, led to an increase in risky financial practices such as speculation and the use of complex financial instruments. These practices were often unchecked by regulatory bodies, leading to a buildup of risk in the financial system. 4. The global financial system. The Great Recession was a global crisis, and many factors contributed to its spread and severity. One key factor was the interconnectedness of the global financial system, which meant that problems in one country could quickly spread to others. In addition, the globalization of the financial industry meant that many banks and financial institutions had exposure to risky assets, which meant that they were vulnerable to losses in the event of a crisis. Lack of regulation. The lack of proper regulation and oversight allowed banks and financial institutions to engage in risky practices that contributed to the crisis. In particular, the repeal of Glass-Steagall Act in 1999 allowed commercial banks to enter the investment banking business, which led to an increase in risky investments and speculation. Additionally, the Commodity Futures Modernization Act of 2000 exempted certain types of financial derivatives from regulation, which allowed for the creation of a complex and opaque financial instruments that were difficult to understand and evaluate. 6. Misaligned incentives. Another factor that contributed to the crisis was the misaligned incentives of various parties involved in the financial system. For example, mortgage brokers had an incentive to issue as many loans as possible, regardless of the borrower's ability to pay them back, because they earned commissions based on the number of loans they originated. Similarly, credit rating agencies had an incentive to raise mortgage-backed securities highly because they were paid by the issuer of those securities. These misaligned incentives led to a culture of short-term thinking and risk-taking, which ultimately contributed to the crisis. 7. Too big to fail. The too big to fail problem refers to the idea that certain financial institutions were so large and interconnected that their failure could pose a systematic risk to the entire financial system. This led to a perception that these institutions were immune from failure, which encouraged them to take on even more risk. When the crisis hit, these institutions required massive government bailouts to avoid collapse, which led to a backlash against the perceived unfairness of the government's actions. 8. Economic imbalances. Finally, the Great Recession was also fueled by economic imbalances both domestically and globally. In the United States, the economy was characterized by a growing income inequality, with the wealthy benefiting disproportionately from the housing boom. Additionally, the trade deficit with China and other countries led to a buildup of foreign debt, which left the United States vulnerable to a sudden loss of confidence by foreign investors. 9. Global financial integration. The integration of global financial markets also played a role in the Great Recession. The proliferation of complex financial instruments, such as mortgage-backed securities, created a web of interconnectedness between financial institutions around the world. When the housing market collapsed in the United States, it had a ripple effect throughout the global financial system, leading to a worldwide credit crunch. 10. Lack of transparency. The complexity of the financial instruments used in the lead-up to the crisis made it difficult for investors and regulators to understand the risks involved. This lack of transparency contributed to a culture of overconfidence and complacency, as many believed that the risks were being adequately managed. When the crisis hit, it became clear that the risks had been severely underestimated, and the resulting panic led to a widespread loss of confidence in the financial system. Conclusion. In conclusion, the Great Recession was caused by a combination of factors, including the housing market bubble, the subprime mortgage market, the deregulation of the financial industry, and the interconnectedness of the global financial system. The severity of the crisis was exacerbated by the use of complex financial instruments and the lack of oversight and regulation. While some progress has been made in addressing the root cause of the crisis, much more needs to be done to ensure that such a crisis never happens again. That's it for today's video. We hope you found this information useful. If you have any questions or comments, feel free to leave them below. And don't forget to like and subscribe for more videos like this one. Thanks for watching.